Covered call ETFs are a great way to generate monthly income. If you own individual stocks, one option for you would be to sell covered calls. This generates monthly income. But the downside is if the stock skyrockets, your shares can be called away. And this could mean that you could pay a lot in taxes. So how can you benefit from covered calls without selling them yourself? Covered call ETFs will do it for you. These are not meant to be your standalone investment. They're meant to be part of a diversified portfolio. And the reason is that the shares could be called away. This means that these covered call ETFs won't see explosive growth. But that's not why you're buying them. You're buying them for their high dividends, income. And yes, the dividends do change. These ETFs do one of two things. Either only sell covered calls, or they do a hybrid approach. So they sell some covered calls, but they also buy and hold. This means that you might see smaller dividends, but potentially higher growth. If you're already investing in an index fund, though, you don't need the hybrid. Smash the follow. Selling covered calls is a great way to generate extra income on shares you already own. So let's say you have 100 shares in a company and you don't think it's going to move too much in the near term. Usually people sell covered calls monthly to earn extra income. If you have 300 shares in a company, you can sell one covered call or you could sell 3. It's up to you. So if I sell you a covered call, you're paying me a premium, and that premium gives you the right to buy my shares from me. But I get to keep the premium regardless. So let's say I have 100 shares in a company that's $10 a share. And I don't think the stock is going to be $15 by the end of the month or in 30 days. So I'm going to sell one call, which gives you the right to buy 100 of my shares. And I'll sell it at a $15 strike price. Now, if this stock isn't $15 by the end of the month, I keep the premium and I keep my shares. On the other hand, if the stock is over $15, you have the right, but not the obligation to buy my shares. But I still keep the premium and I have a profit on my shares. If your shares get called away, you will owe taxes. Which covered call ETF dividend is better? JP Morgan's premium income or QYLD? At first glance, it's definitely JP Morgan. They'll give you $6 for every share that you own. And QYLD will only give you $2.09. But QYLD pays 13.3% and JP Morgan pays 11.3%. JP Morgan is more expensive though at $53 and QYLD is $15.87. So if your goal was to make $1,000 a year from the dividend, you'd need 166 shares of JEPI, which would cost you $8,930, or you would need 478 shares of QYLD, but that would only cost you $7,500. But wait, there's more. JEPI is only down 12% year to date, and QYLD is down 30% year to date. Smash that follow. I want to make $20,000 a year from JP Morgan's premium income ETF. How many shares would I need? You'd need 3,546 shares, which would cost you around $191,000. I'm going to watch the tagged video below, but you should make more of these. They're really helpful. Sure, just hit the follow.